Hey everyone! Season 3 of Grow Organically will be coming back in a few weeks. We have some awesome guests and interesting topics lined up, including a deep dive into our new Growth Proficiency Report, which is available for download on Catchlight.ai. In the meantime, we are re-releasing some of our favorite episodes that are jam-packed with valuable insights. Have a listen and share with your colleagues. You'll be hearing brand new episodes, plus have access to full-length video episodes very soon. Welcome back to the program. It is my delight to welcome my guest today, Jimmy Zhao. Jimmy's a partner at McKinsey, where he's been for the past 11 years. He leads the growth strategy development and implementation for wealth and asset management clients. Prior to joining McKinsey, he was in the portfolio management group at Credit Suisse. Jimmy, tell us a little bit about your work at McKinsey. I think one stat that you shared with me that kind of blew me away is that you've been involved in 50 plus transactions in the wealth space over the last 6 years. That's quite a lot of work there.
It's been a busy time in wealth management for deal making, without a doubt. So in terms of my work, I led our U.S. retirement practice. That includes wealth management, 401k, defined contribution, that whole ecosystem. I work with firms in that space, whether it's banks or independent firms, on growth topics, like you mentioned. And I spend the other half of my time working mostly with financial sponsors, some strategics, on deals in the space. As you mentioned, 50 transactions, 35 of those were for some of the larger RIAs. I had a chance to look at most of the top 50 kind of RIAs on the Barron's list that went through their processes over the last 6 years, as well as wealth techs and other firms in the ecosystem.
You've probably got a lot of stories to tell, Jimmy.
Some hairy deals there, Dan, no doubt.
Yeah. So, so M&A, inorganic, that's one side of growth. And our program's really about organic growth. So let's dive in. First question here is, what is driving consumer demand and adoption for wealth management? How are consumers searching for and discovering wealth firms today?
Yeah, a few things to hit on there, Dan. First of all, we've been tracking organic growth in the industry over the last 13, 14 years. And the first, maybe more macro point is that typically over the last 14 years, organic growth each year has been between 2 and 4%. Now, I think it's important to define organic growth. That doesn't include advisor movement. It doesn't include dividends or interest. It is truly kind of client-driven demand for wealth management services, right? Existing clients adding more money than they're withdrawing, new clients looking for advice and adding an advisor. So typically, 2 to 4%. In 2024, it was the weakest demand that we have seen. It's 2%. Now, I know that's different from some of the other publications out there, but keep in mind that in this interest rate cycle, any definition of organic growth that includes dividends and interest will be quite high in 2024. If you remove kind of interest, remember in 2023, consumers were getting basically nothing on their cash, right? If you kind of remove like the dividends and interest and yield on cash, we see only 2% organic growth in 2024, relatively weak, and we expect 2025 to look a lot like that. The reason why I give that context is if you juxtapose 2024 with 2021, I think most of your listeners would say that 2021 was really a banner year for organic growth, right? We saw upwards of 6.5% in terms of organic growth for wealth management. So, what was happening in 2021? Obviously, a lot of tax changes, a lot of other kind of macroeconomic dynamics, early retirements, a big driver of seeking demand. And unfortunately, a lot of, life events happening in 2021, right? Our research would show that about 50% of new advisor relationships start with one of the 6 or 7 most common life events. That would be first child goes to college, marriage, divorce, retirement, death in the family, liquidity from business sale. Those 7 really drive half of new relationships. And there's a lot of that going on in 2021. Obviously, some of those things are not cyclical. In 2024, pullback in demand, partly because some early retirements were pulled earlier into 2021, 2022. But a lot of it was also kind of the dynamics around cash and folks kind of keeping money on the sidelines, deleveraging, paying down mortgages instead of putting, money to work in the markets, what have you. You also asked a question around how people find their advisor. I think that's also a really interesting dynamic. We do a 7,000 household survey every year around this very topic of kind of consumer needs, how clients find advisors, why they might leave their advisor. And we're seeing significant growth in how folks are finding advisors to the workplace. That's up to 12% now of new advisor relationships starting at the workplace. And we would project that by the end of the decade, that going up to 20%. So 1 in 5 advice relationships starting in the workplace, which is obviously really exciting and a mega trend for firms that are leaning into that.
Super interesting. And that 2% number, that's pretty scary. Slowest year of growth, organic growth in recent memory. I saw a headline this week, quite a large firm, one of the top firms, paused a sales process due to concerns on organic growth. At least that's what the headline suggested. Curious to get your perspective. Why is that? Why is it only 2%? And why should firm leadership care about that?
Yeah, well, in terms of kind of low organic growth, we do think interest rates kind of play a big role in that. Obviously, it's a bit of a shock in some respects. We see it especially slow with ultra high net worth net flows. And that might make sense because those are households that are really strategically using credit, right? And if they have floating rate credit, they might be paying those down instead of kind of putting more money with their advisor and putting more money to work. Also a very slow business liquidity cycle, right? In 2021, a lot of folks were selling their businesses. IPO market was really strong. Extremely weak IPO market the last 18 months and business sales cycle. Now I think we see some leading indicators in our work with kind of firms thinking about IPO or firms thinking about kind of doing M&A. That's really picked up in the last kind of month or two. And all signs point to a stronger 2026 cycle in that respect. Obviously, there's a lot of uncertainty around interest rates and general kind of macroeconomic dynamics here. But if things play out the way that they seem to play now, I would expect 2026 to be kind of a rebound in terms of organic growth. Now, you asked why it matters. It matters for a number of reasons. And look, to keep it in context, folks who are not in wealth management listening to your podcast, Dan, and hearing that 2% organic growth is really challenging, they might be in the mortgage brokerage industry and say, hey, cry me a river, Dan, right?
Yeah, I'd take 2% all day long, right?
Yeah. If a bus cycle is 2% organic growth, I think this is still a really resilient industry because, a lot of folks out there need advice and not just because of whatever's going on in the market, right? But having said that, why should folks care? I think number one, advisors want to be part of a platform that's growing, right? That there might be positive impacts on their ability to acquire clients, positive impacts in terms of the ability of a firm to keep upping their game, right? Clients want more, they expect more from their advisors year over year. That's what our consumer survey tells us as well. And so they want to be part of a firm that's kind of, flourishing and growing and reinvesting, right? It helps with your M&A. You can show up with the biggest check, of course, but if you show up with something differentiated in terms of helping advisors thrive and grow and be successful, obviously advisors want to be a part of that. It also has a big impact on your valuation. Doesn't take a mathematician to understand that valuations of a business are highly correlated with organic growth. And if you can show that your organic growth is higher than market, durable, diversified, something that you can really underwrite for years to come, we see that having big impact on valuation and whether or not a process stalls or goes through, right?
Awesome. Love that. And another thing that we had talked about in preparation for this conversation in particular is this year being the peak number of baby boomers hitting 65. And so what's the impact of that life event, that transition, and how's that affecting organic?
Great question, Dan. Yeah, not sure exactly what happened 66 years ago, but obviously a lot of a really high birth rate that exact year. So the largest portion of kind of the baby boomer generation reaching retirement age this year. Major impact in terms of organic growth, given that a lot of folks seek advice around that time, right? I like to say that accumulation has been mathematically studied and in some ways mathematically solved for, a good portion of people, right? But investing is easy till it's not. Everyone starts with a brokerage account until it gets, until things get difficult. And, obviously a lot of folks wait until getting closer to retirement to execute on that, right? Just think about, the decision to take your Social Security at 62 versus age 70, right?
Mm.
A huge impact on your retirement plan. Very difficult to think through objectively and make an unbiased decision around that, right? I think for a lot of folks, it might make sense at 62 to, start spending down some of your, retirement savings and then waiting to take Social Security later. Obviously, that's not the right decision for everyone. And getting some professional advice around that is critically important. Decumulation is very personalized in a way that's difficult for, a robo or an algorithm to solve today. And, Dan, you see a lot of well-performing marketing campaigns around the topic of retirement, right? So, a lot of smart money being spent on kind of helping people and recognizing that that's an important inflection point.
We're going to get to marketing spend in a few questions, Jimmy. I'm glad you brought that up now because I think it's an interesting topic, one that I talk to my counterparts, the CMOs at the firms that we work with quite a bit. But before we get there, I'm going to pose a question. So thinking of yourself as the CEO of a $25 billion firm. You're growing at 2% organically, but you spend the bulk of your time on M&A. You know that space inside and out. Why should I, as the CEO of a $25 billion, or you as the CEO of a $25 billion firm who's been really driving the business from an M&A perspective, why should I care about organic? You mentioned valuation before, but what else? Is there anything else I should be thinking about?
First and foremost, we did talk about valuation, and obviously that should matter. As you do in M&A, if you're offering equity to advisors, they should also care about valuation, right? So kind of the value of your stock matters for obvious reasons, but also matters because it's currency, that you're using with your staff, with your team, and obviously that's important as well.
Mm-hmm.
As we think about like where do folks want to work and bring their business and thrive and serve their clients, I think they're looking for firms that are growing organically, whether it's something special that firm can do to help that advisor, right? What is driving that organic growth? Is it centralized lead gen? Is it marketing spend? Is it that the advisors have access to more resources? They're more productive. They have more capacity. Whatever it is that firm is driving and investing in to help those advisors grow, those are all things that advisors are looking for, right? So if you're out there doing M&A, you recognize that it is a very difficult M&A market. There's 10, 15, 20 bids for many of the firms out there, especially if it's a banker-led process, very competitive M&A. I think having a differentiator, there could be many differentiators, but I find that the differentiator that resonates the most with many of these sellers is, how are you growing organically and how are you helping advisors grow, right?
I love the connection that you just created between organic growth, culture, how that affects an M&A deal, affects valuation clearly, and really the opportunity for the advisors on either side of that transaction. That culture of growth. I think that's a really important element for how firms should be thinking about and strategizing to be able to attract more advisors who want to maximize their time and their effort, increase the size of their books and things like that. But something you said to me in one of our conversations recently, you said organic growth is difficult and it's rare. 2% clearly. What any key drivers behind that you can think of?
Yeah, well, first, just to double back on that culture point. It's true almost across industries, right? Firms that are growing tend to have a stronger growth culture. It's mutually reinforcing. Just to make that a little bit more obvious, growing firms have more opportunities for their teams, right? So if you are an advisor with Gen 2 advisors, a broader team, you're selling to a platform, you also want to make sure that regardless of how long you plan to work, that, the advisors that trusted you with their careers, that you trained and apprenticed for decades, that they're going to have opportunities to grow and thrive and flourish. And they're joining a platform that's going to introduce clients, introduce new capabilities. So all that to say, I think people that are growth minded are attracted to platforms that are growing because it creates more opportunities for them and for their teams. And that matters to folks.
Hmm.
Organic growth is difficult for a number of reasons. When we track ADV data for RIAs, we find that 3 out of 5 RIAs are actually in outflows, right? Of course, there's thousands of RIAs out there. Not all of them are in growth mode or have a growth ambition. But obviously, it's difficult to even keep track, with organic growth. And look, it's been a great decade of market performance, right? So ADVs are getting larger, but when you back out market growth, a lot of firms are not adding clients or they have clients in outflows. In some respects, I guess, for a number of advisors, their books are much larger. They're, generating much more revenue. Maybe organic growth is less critical and depending on kind of what they're focused on. But organic growth is also hard in the sense that there's a lot of scale benefits for organic growth. So we'll talk about marketing spend later, but typically my rule of thumb is if a firm can't spend more than $5 million on marketing, it's probably not worth it to really get into it. And marketing also benefits from having a bifurcated sales and service model. I know some of your other podcast guests have talked about that. That's also difficult to implement without a certain amount of scale. Mm-hmm. I talked about more households finding their advisor through the workplace. Okay, sounds good theoretically, but most advisors don't have any access to the workplace, right? Or the ability to, meet high earning employees, with the benefit of approval from their employer. These are all things that, require some level of scale. And I think that's why you see, a number of advisors, not outgrowing the market overall.
It requires scale, requires skill, requires access, certainly from a channel perspective. So with that, maybe we'll transition a little bit. You've done some work with banks in particular. How do you see the role? What's the role that banks are playing in capturing demand? You've talked about consolidation of services, a broader suite of products. Could actually be an advantage for banks, seeking to identify those prospects that may live within their current depositor list and trying to migrate them over to the wealth side.
A number of banks have growing with the wealth management business as a top 2, top 3 strategic priority, right? It makes a lot of sense, especially when we look at regional banks. And there was, a period of kind of immense pressure on regional banks during this interest rate kind of inflection. Those banks are now seeking to diversify their revenues, right? Find more durable sources of fee revenue. And in a world in which kind of banks have largely gotten rid of ticky-tack, fees, right, on your accounts. The best way to get fee income now is either wealth management, number one, or credit cards or investment banking, but not all regional banks can really have kind of credit card or investment banking franchises, right? So wealth management kind of almost by default, but also strategically is very important to banks. And they want to deepen their relationships with their customer base as well. Now, there are some obvious advantages that banks have. The question then is, why are so many banks struggling, right? So let me go through that in order. Well, our consumer survey tells us that, year over year, as we've gotten farther away from the financial crisis, especially younger consumers, but all consumers say that they want to combine their banking life with their investing life, right? When we ask folks, would you be open to investment products or financial advice from your bank? That's been increasing year over year. It's well over 50% in the age 25 to 44 cohort, maybe a cohort that, didn't really experience the financial crisis the way that, the older generations did. So clearly kind of consumers see that intuitively it makes sense that I should get some benefits from combining and simplifying my financial life. I think also other industries have trained all of us that loyalty should be rewarded, right? And banks are in a great position to reward loyalty by having kind of a value proposition that combines, banking and investments. And if all of that sounds like nirvana, Dan, how many banks can you think of that are really delivering on that?
A case in point, I was with a startup years ago. We sold, and I was fortunate to have a nice check proceeds from the transaction end up in my personal checking account because that's where my direct deposit went. And I never got a call from the bank, which I was
You
shocked.
never got a call.
I wasn't in this industry at the time, but I was still surprised that nobody called me to say, "Oh, hey, you've got some cash in here. Let's put it to work."
100%. I mean, even being able to surface that data is difficult for some banks. Obviously, there's some consumer data that, from a legal and compliance point of view, can't be used for marketing purposes. But what you just described, should have, raised the flag, right? Um, so some of that data is being kind of lost. In today's world of um, call transcripts and better understanding, you can, imagine a world in which branch interactions are better understood and tracked. Phone interactions, digital kind of experiences, but all of that is mostly trees falling in the forest and not being heard. So there's usage of data. I think there's also, just generally speaking, a siloing at many banks, right? And this gets to any kind of situation where we're asking, a professional frontline set of employees to refer to, a different set of colleagues, right? There's incentives involved with that, processes, training involved in that. Managers play a big role. And, that's a big program. It's a big undertaking. And I think many firms kind of take it lightly that it's not that easy for, folks in the branches or what have you to really understand how to help a customer navigate towards the right, wealth management offering or investment offering or what have you. So I think there's a kind of a frontline capability aspect that's holding them back as well. I think thirdly, look, wealth management is a very different economic business than most transactional banking products, right? It is a potential 10-year, 20-year relationship, right? With very sticky recurring fees. And in that respect, it looks more like a SaaS business almost, like a subscription-based business. And if you think about, okay, well, if I'm going to get 20 years of a relationship with a customer, should I be willing to pay 1, 2, 3 years of that revenue upfront to acquire that business? Many firms would say, yes, that sounds great. Sign me up. But for many banks, that would put, significant margin pressure on the business, right? So it's a different way of thinking about the economics that I also find that, it doesn't fit the kind of immediate term or near to medium term, like financial goals of some institutions. And therefore, they underinvest in that opportunity as a result.
I was going to say it's sort of ironic that we're talking about wealth management, investing for future growth and returns, and meanwhile, you're suggesting, and I think we see it, that firms are perhaps not ready to do that, not ready to sort of be all in on what that future growth will look like from an investment perspective in the marketing. So maybe we'll transition to that. This is another area that we've talked quite a bit about, whether it's banks, RIAs in particular. There seems to be a hesitancy to spend on marketing. We've got lots of great clients, and so we see a little bit deeper into their budgets and their strategies, and we can see who's spending and what they're spending on, and it makes a lot of sense what they're doing. But from an RIA perspective, I think some of your research suggests that 46% of revenue is spent on tech. I've seen data out in the market that suggests that 3% of revenue is spent on marketing. That's 4 to 6% for front office and back office. Tell me why. Tell the audience why you think marketing budgets for firms, why aren't they investing more? Whether it's a bank or an RIA. What's the case here, and what advice would you give firm leadership in terms of investing in future growth?
To answer that last question first, my advice would be to spend more. I think I've seen, as you have, many situations where especially for performance marketing, the ROI to be quite attractive. I bring my colleagues who do marketing in consumer goods or technology, over to look at the wealth space, maybe talk to my clients in the wealth space. And they are, flabbergasted by two things. One, how good the ROI can be on marketing in this space, just how much, white space there is to continue to market and reach customers, even, when you're relatively small compared to the big kind of behemoth wealth firms. And secondly, just how many years behind wealth management marketing can be versus, big brands, consumer goods or restaurants or what have you in terms of how sophisticated the marketing can be in those organizations. So I think there's a lot to do in this industry around marketing. And certainly, I would recommend that it's well worth the effort to see if it works for your organization. Why do firms not go down that route? A big question I get from banks is, hey, can we capitalize wealth management marketing? And that question comes from a place of, the accounting rules treat wealth management differently from banking products. Like you can, in fact, capitalize marketing spend on many banking products. That is very friendly to, quarterly reported, earnings and margin, right? And I think that question underlies, again, just the fundamental difference in the economics of this business and the need to think about it differently, right? And I think that the best firms out there who are spending money on marketing recognize that. I think for some firms, there is cash burn here when it comes to marketing, especially for firms with maybe an external capital partner. If you're spending first year of revenues, first 2 to 3 years of earnings on to get a client, you are really banking on having that client for 5 to 10 years, and you need to take a 5 to 10 year perspective on organic growth, right? Obviously, if you're tracking organic growth just from assets, those assets come. But if you're looking at your earnings, those earnings come 3 to 4 years later. So the kind of implied cash intensity of growth can also be kind of daunting and a little bit intimidating for certain firms.
It's funny you brought up, and I love the notion of bringing your colleagues from the CPG side of the world into these conversations. I've been in SaaS the bulk of my career, and I think of the business and the health of the business in terms of LTV to CAC ratios. Mm-hmm. And when I first joined Catchlight and started to work with lots of advisors, I was sort of in firms scratching my head saying, why not invest more? I mean, I think the average lifespan or lifetime of a wealth client to a firm exceeds 15 years. And so if you're looking at that LTV to CAC ratio, and in a SaaS world, 3 is good, 5 is great. And you look at wealth, and it's 20, pretty phenomenal. And so just it makes me wonder, why firms wouldn't think more about feeding that cycle, putting more into that investment, knowing that if you get $1 million client, 1% fee, $10,000 a year, $180,000 over a lifetime of 18 years, how much are you willing to spend to get that? Is it 3,000, 5,000? There are different averages out there. We've seen numbers in around $10,000, but mm-hmm. If your lifetime value for a client is $180,000, would you spend $40,000 to get them?
Right.
And I suspect there is some pressure from investors in firms that are looking for a faster return, and there's an investment cycle from those investors in firms where maybe at the onset of that investment, maybe this is the question here. The onset of that investment, there's willingness to spend and drive up that growth. You sort of get that flywheel going, but towards the tail end of that investment, maybe it's all about margin, so they can start to think about what that next transaction may be. Is that sort of typical from your perspective?
Well, I do see some private equity owned firms with that kind of 3 to 5 year kind of fundraising cycle kind of struggle with a program with that J curve, right? Of
Right.
kind of, you have to invest for 3, 4, 5 years before you really see kind of the margin payoff. So obviously that can be a challenge, but if I take a step back, I mean, I also want to, kind of get into the psychology. Yeah, there is perceived risk, right? You mentioned like, well, if you could pay $10,000 for a client that, ultimately generates $10,000 in revenues for a decade plus, um, obviously that math makes a ton of sense. The question is, when you start from scratch, you're not going to get that level of performance, right?
Right.
It's, in your first year, you're testing, you're learning, you're hiring a digital marketing expert, maybe you're onboarding a new marketing agency. The performance might be 50,000 for that first client and 60,000 of marketing until you get that second client. And obviously that can be, the math starts to change. You have to believe that as you put more money into it, the performance will get better.
Yeah.
But I do see some kind of kind of some of these marketing pilots that die on the vine based on kind of early results, but with the understanding that your early results are really kind of, you're paying for the education of building that business. And I think over time, again, it is kind of 3 to 4 years underwater. And again, it doesn't have to be just a private equity owned firm. I think a number of institutions would look at that and maybe balk at, investments that take that long.
Yeah. It's fascinating. I just, from my perspective, invest in, if it's a 3-year payback period, okay. And that could just be part of the model. That's part of how you think about valuing the business. And as you build these programs, bring in these new prospects, convert them, you're building for future valuation. You
100%.
talked about it before. Organic growth has a correlation to firm valuation. So, while you may be underwater the first 2 years, there's so much potential given the stickiness of the relationship between the advisor, the firm, and their end client.
100%. I mean, as we kind of recognize the importance of organic growth and the opportunity to drive it more essentially, I think, Dan, your question is also highlighting that it is really hard. It's going to be a journey, right? But
Yeah.
obviously it's probably the most important journey that, a firm or an institution can undergo.
Yeah, and it's an investment,
100%.
plain and simple. Yeah. So another area that we've poked at is crossover. So we talked about banking to wealth, a pretty common use case. We hear about it a lot. Got a number of banks on our platform today, which is great. We also hear from retirement plan to wealth, folks that are looking at that space, CPA to wealth. We hear about these referral programs, whether it's internal within the firm, bank, deposit account to wealth, or external, third party to third party.
Mm-hmm.
Would love to get your take on referral networks. How should firm leadership be thinking about how they contribute to the growth of their business?
Well, I think, referrals are a great source of organic growth. There's no doubt. Obviously, when we talk about centers of influence strategies at a very local level, many of the best advisors in the industry have been leveraging that their entire careers, right? And so in some respect, some folks might hear that and say, hey, nothing new here. I've been partnering with local kind of professionals in my community my entire career. The question then becomes, how do we do that at larger scale, at maybe more of an enterprise level?
Institutionalize it.
Exactly. And that becomes difficult, right? You can't, of course, teach advisors at larger platforms can encourage, incentivize, teach advisors to cultivate those relationships at a local level. And they absolutely should. We think kind of training around that has atrophied at many institutions, but I think, that type of practice management is critically important. And at the institutional level, I think thinking about it as ultimately kind of a B2B joint venture or a partnership, right? Where there will be a splitting of the economics naturally.
Mm-hmm.
There will be back and forth referrals with that other institution as appropriate. But I think there's some major referral programs in the market that have taught us a lot about what works, right? So the major custodian referral programs, which have been mentioned by some of your guests in the past, have highlighted, what really drives up conversion rates from a referral program and ultimately customer satisfaction, client satisfaction, right? I think number one, the existing relationship. So the institution that has the existing relationship, kind of surfacing the needs, really trying to understand that customer. It's not just, hey, here's a QR code. Would you like to scan it? Obviously that's a different approach. I suppose if, I suppose there's some situations where that makes sense, but I think we've seen that conversion rates are much higher when, hey, that initial introduction to the wealth management service is consultative in nature to begin with. That customer is given options, options that meet their needs and, have the ability to, get introduced, in a warm way, right, to the wealth management partner. And ultimately, I think the wealth management partner also investing in this relationship. I'll use the CPA example you gave. If a CPA is introducing wealth management services to a business owner that is doing tax filings with that CPA, right? You want to hand that off to a wealth management advisor that works with small business owners, understands how that CPA does their business, understands the types of customers or customer segments that CPA typically works with, maybe provides feedback back to that CPA about, hey, this is your customer too. Like, this is what, we're learning as appropriate, of course, based on what's shareable. But all that to say, treating it like a partnership, thinking about what's best for the client, and at the end of the day, sharing economics, again, as legally possible. Obviously the referring partner would have to have some kind of RIA or other kind of legal entity if they're going to collect basis point fees. But there's other ways to strike, economic arrangements such that it makes sense for all parties.
Yeah, I mean, I think this subject is probably an episode in and of itself. Understanding and capturing that need, capturing that intent of the end consumer investor, whether you're on the wealth side, perhaps referring to somebody on the tax side, or retirement plan side to the wealth side. It just makes so much sense as our lives and financial lives get more and more complex, to have trusted individuals on each side of that. And I think there's an interesting opportunity to institutionalize the referral, buy-in between groups within an institution, and then buy-in between different firms, through the relationships that we've talked about.
Yeah, 100%, Dan. And well-run referral partnerships like the ones we referenced earlier. I mean, you could see client close rates of up to 50% from the wealth manager's point of view, right? Now, what does that require? It requires kind of the partner on the other side, the relationship kind of holder with that client, really having a thoughtful conversation, maybe not referring every single client, if it's not a good fit for the wealth manager and it's not going to close, right?
Yeah.
Maybe triaging that up front, but also positioning the wealth manager, having a warm handoff. We find that when the first meeting from the wealth manager with that referred client, if the original referring relationship manager is in that meeting as well, the close rate goes up dramatically, right? And so, if the aspiration is something like a 50% likely to close client from a wealth manager point of view, that's the perfect lead, right? There's no wasted effort. There's no wasted time. Like, these are high intent clients that are being introduced to you the right way. Compare that to a digital marketing lead or some of these kind of web, lead generating affiliates. You see 1%, 2%, 3% close rates, right? For a lot of advisors, that's a really frustrating lead to work with. So all that to say, a lot of upside to getting the referral partnerships right.
Jimmy, thanks for that. So the last question, if you knew then what you know now, 5 years ago, what advice would you have given yourself when thinking about organic growth?
If I were to go back in time 5 years, I think I would encourage, Jimmy, the consultant, to spend, even more effort trying to help our clients grow organically. That's been a big part of our practice, but obviously still, to this day, a lot of untapped opportunity to continue to invest in this. So, our clients are, investing in this now, but I think over the last 5 years, it's obviously been a major, major theme. Now, if I were kind of an RIA owner or some of the folks who are advisors who are listening to your program, I guess, if I were in those shoes, 5 years ago, I would have, if we talked about a J curve that is 3 to 5 years long, ideally you start every J curve 5 years ago, right? So that you're reaping the benefits today. So all that to say, I think still a lot of white space, still a lot of innovations happening in organic growth. Whether it's marketing or the referral partnerships that we're talking about, still a lot of space to craft those. Never too late to start, but I think a lot of firms would have even higher valuations or maybe successful processes if going back in time 5 years, they were able to make those foundational investments that would be paying off now.
Sage advice to both Jimmy 5 years ago and to RIA leadership even today. Make those investments. Jimmy, I want to thank you so much for taking your time, sharing your knowledge. Your background is awesome. Every time I chat with you, I get smarter about the industry. So thanks very much for being here today.
Thank you so much, Dan.
Thank you for listening to the Grow Organically podcast. If you enjoyed this episode, click the follow button to be notified when new episodes become available. Visit catchlight.ai, where you can access all our podcasts, including show notes and other resources to keep learning. This podcast was produced by Catchlight Insights, LLC. It is for informational and educational purposes only. The content of this podcast does not constitute an offer or recommendation of any securities and is not intended to provide tax, legal, or investment advice. The views expressed are those of the speakers and not necessarily those of Catchlight or its affiliates, and are as of the date indicated, based on the information available at that time, and may change based on market or other conditions. Catchlight does not assume any duty to update any of the information. Catchlight and other third parties mentioned in the podcast are independent entities and not affiliated. Catchlight does not endorse any investment advisor or provide advice or recommendations to any prospective or existing client of an investment advisor as to the selection or retention of that investment advisor. This information is not intended for any person or entity in any jurisdiction where the distribution or use of such information would be contrary to local law. Third-party trademarks referenced herein are the property of their respective owners. All others are the property of Catchlight Insights, LLC. Copyright 2025, Catchlight Insights, LLC. All rights reserved.